Although it has been a longtime favorite of the stock market, Amazon had a challenging year in 2022. It recently became the first publicly traded firm ever to lose $1 trillion in value, which is a sign of how far the company and its FANG stock counterparts have dropped. The company's share price is down 40% year to date. Although Amazon's recent performance has undoubtedly been disappointing for shareholders, there are still several compelling reasons to purchase the company in 2023. Hey, welcome to Stock Market Mate. Today we'll talk about the 12 reasons why you should buy the Amazon stock in 2023. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Despite some general market volatility, Amazon.com is again within striking distance of a $1 trillion market valuation, following the release of astronomical fourth quarter results. Over 7% of Amazon's stock price rose as a result of higher than anticipated sales and cloud revenue. The amount of profit per share exceeded consensus analyst projections by more than 60%. The market has been reassured by Amazon's strong quarter that the company continues to invest in its business wisely. With that, Amazon can be a promising investment in 2023. But let us discuss this further. Number 12. Retail margins rebound. Amazon's non-AWS profits have been reduced by one-day shipping investments, and according to Post, this trend will probably continue in the first half of 2020. Amazon's North American profit margins decreased from 5.1% to 3.5% in the fourth quarter. However, according to Post, these investments should return to normal by the second half of the year, while Amazon's high-margin AWS and advertising businesses are expected to generate operating profits of $2.5 billion and $2.2 billion respectively in 2020. This increase in margins will boost profits while also giving Amazon more financial freedom to perhaps engage in future growth efforts. Number 11. Amazon Web Services is still a favorite. It's a touch cliche to claim that Amazon Web Services is worth at least as much as Amazon's market capitalization. The data demonstrates why. The cloud infrastructure business's sales during the first 3 quarters of 2022 increased by 32% year over year to $58.7 billion, giving it a $75 billion annual run rate, and its operating margin is now 30%. AWS would be one of the most successful businesses in the nation if it existed alone. It is true that the growth rate has moderated a little, reaching 27% in the third quarter. AWS is still expanding quickly, especially for a company of its size. This was caused in part by macroeconomic headwinds as its clients have grown more cautious about regulating their spending. Number 10. The advertising industry is flourishing. Amazon's advertising sales increased by 30% in the third quarter, despite the fact that almost all digital advertising platforms reported lackluster growth. It currently ranks third in the US in terms of digital advertising platforms after Facebook and Google, and is expected to bring in about $40 billion this year. Due to the fact that third-party sellers are reliant on Amazon ads in order to sell their products and have no other comparable platform to turn to, the company's robust growth in the face of a difficult macroeconomic environment is evidence of the sticky nature of the industry. Number 9. Amazon's customers are loyal. According to a recent Bank of America survey, 58% of online customers begin their search on Amazon, while only 25% use Google, a subsidiary of Alphabet's parent firm. Additionally, Post discovered that compared to respondents who said they're using Amazon's platform less, 34% more respondents stated that they're doing so now than they were a year ago. This ratio of increased to decreased usage is better than that of any other firm in the poll and shows Amazon's upward trend. Finally, up from 26% a year earlier, 30% of respondents indicated they do between 76% and 100% of their online shopping on Amazon. Number 8. The future looks more lucrative. Amazon has long placed more emphasis on investing in long-term growth than it has on producing immediate profits, which has resulted in lagging profits. But as the business grows, management appears to be realizing that some costs have gone out of hand and that even a business that values experimentation can go beyond. Amazon recently closed Scout, their delivery robot, as well as Amazon Care, its telehealth and in-person healthcare business. The management is reportedly planning to fire 10,000 corporate employees from departments including Alexa and other gadgets, retail, and human resources. That ought to improve the financial results. Number 7. Bezos is still involved. Daily operations of the business are no longer handled by Jeff Bezos. Last year, he delegated those responsibilities to CEO Andy Jassy, who had previously led AWS. Bezos is still the executive chairman and the company's largest shareholder, though, and Jassy frequently consults with him. You can bet that he will have a say in any significant corporate decisions. Number 6. The economy will improve. Amazon is not a business that can weather economic downturns. Sales of discretionary goods are the foundation of its e-commerce company, and both cloud infrastructure and advertising are cyclically sensitive. A number of macroeconomic issues that will eventually pass are partly to blame for Amazon's disappointing recent results and expectations. Additionally, the effects of the rising dollar's overseas headwinds will lessen, boosting revenue growth. Number 5. The economy will improve. Given its current valuation criteria, it may be difficult to describe Amazon as cheap, but the company is still well valued, given that it is down almost 50% from a year ago. The company is fundamentally the same as it was a year ago, despite the fact that its growth and profitability have decreased. However, any number of catalysts, including the ones mentioned above, could aid in re-establishing growth and profitability. When market sentiment changes, Amazon should quickly recover. Number 4. Its benefits over rivals are evident. Because of its immense strength, Amazon frequently sends potential peer stocks into a tailspin, just by implying that it might enter a new sector. For instance, Shopify shares had a significant decline this year, in part due to the threat posed by Amazon's new Buy with Prime program, which enables independent websites to offer things with Prime shipping. Amazon may enter new industries thanks to its competitive advantages, which include Prime, its third-party marketplace, fulfillment by Amazon, its extensive network of warehouses, and its stellar reputation for customer satisfaction. These characteristics also contribute to the reason why Amazon continues to rule American e-commerce with a market share of roughly 40%. Its ability to hold onto that sizable market share is no small accomplishment, given that it now competes with online platforms like Shopify, as well as brick-and-mortar behemoths like Walmart, Costco, and Target. Number 3. There will be additional experiments. There are still many projects in Amazon's pipeline that have the potential to be very profitable. Consider Amazon Go as an example. Customers may purchase items at Amazon's convenience stores without ever stopping at a checkout counter to make a purchase, thanks to the company's Just Walk Out technology. Convenience like that cannot be equaled by traditional retailers. One example of the corporation innovating on the customer's behalf is the addition of the Just Walk Out technology to Amazon Fresh stores and even some Whole Foods locations. Amazon's corporate culture places a high value on innovation and experimentation, and this, coupled with its expertise in industries like e-commerce and cloud computing, will be the key to its future success. Number 2. The cloud and online retail industries are continually developing. Amazon has been in the internet retail business for many years. Amazon Web Services, also known as AWS, is the company's cloud division, and it is not a recent addition. Despite the fact that both of these companies are already sizable and well-established, according to Post, they are both still in relatively early stages of growth. Gross merchandise volume for global e-commerce in 2019 was $3.2 trillion, up 19% from 2018. In 2020, Post anticipates further growth of 18.5%. According to Post, the worldwide e-commerce penetration rate could eventually increase from 11% to more than 25%. By 2021, he predicts that AWS cloud sales might reach $57 billion. Number 1. Growth in the sale of luxury goods. Amazon has previously made unsuccessful attempts to enter the high-end fashion market, but the corporation is apparently now collaborating with at least 12 high-end labels to create a new platform that will sell just high-end goods. According to Post, the luxury platform will be a distinct area of Amazon.com and will provide retailers more control over the look and feel of their websites, enabling them to preserve and strengthen their brand identities. Tmall Luxury Pavilion, the Chinese e-commerce behemoth Alibaba Group Holdings, or BABA, dedicated site for high-end brands, is having success. According to Post, Amazon should focus on the important segment of luxury shopping. Well, that's about it for today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video.
If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!